Let me ask you something. When was the last time you actually walked into a bank? Not an ATM, not an app. I mean, physically walked through a glass door, took a number, and waited in line to talk to a teller. For most of you, it's been a while, maybe years. And that gap, that distance between you and your traditional bank, is exactly what some of the most powerful companies on the planet are trying to fill. We're talking about Apple, Amazon, Facebook, Alibaba. They don't just want to sell you gadgets or deliver your groceries anymore. They want to be your bank. And what's terrifying, depending on which side you're on, is that they might actually win. To understand why this battle is happening, you have to understand a power shift that's been quietly unfolding for over 2 decades. Cast your mind back to 1999. The dot-com boom is in full swing. The internet feels like magic. Companies like Cisco, Microsoft, and Intel are sitting at the very top of the world, the most valuable companies on Earth. Tech ruled. Then, the bubble burst. And by 2009, the landscape looked completely different. In the aftermath of the dot-com crash and the global financial crisis, it was energy giants and financial institutions that clawed their way to the top. ExxonMobil, Berkshire Hathaway, and, interestingly, a Chinese bank, ICBC, the Industrial and Commercial Bank of China, became one of the most valuable financial institutions on the planet. Banks and oil companies, that was the world's pecking order. But flash forward to today, it's not even close. Microsoft, Apple, Amazon, Alphabet, Google's parent company, have completely reclaimed the throne. We're talking about companies worth trillions of dollars. The banks? They're still there, still massive, but they're no longer at the top of the mountain. And here's the critical question. Why does that matter for your wallet? Because the most valuable companies in the world don't just sit on their hands. They expand, they grow, they look for the next frontier. And right now, that frontier is finance. Now, to understand how tech got this opening, you have to go back to 2008. The financial crisis didn't just destroy wealth, it distracted an entire industry. Banks were suddenly drowning in regulatory investigations, government bailouts, new compliance requirements, and billions of dollars in fines. Their attention was pulled inward, survival mode, fix the balance sheet, deal with regulators, keep the lights on. Meanwhile, and this is the crucial part, while the banks were staring at their feet, tech companies were revolutionizing daily life. Think about what happened in that same window of time. Uber put a taxi in your pocket. You didn't have to wave down a cab or carry cash. Just tap, ride, done. Airbnb turned spare bedrooms into global hospitality businesses. No hotel chains needed. WhatsApp let you call and message anyone on the planet for free, cutting out telecom companies entirely. These apps didn't just change behavior, they raised the bar for what people expected from every service, including financial services. Suddenly, consumers were asking, if I can order a car in 30 seconds, why does it take 3 business days to transfer money? Why do I need to fill out a paper form to open a savings account? Why is my bank's app so terrible? That expectation gap, that frustration, became a billion-dollar opportunity, and tech companies noticed it. Here's where things get really interesting, because big tech didn't just notice the opportunity, they started moving in. Let's start with Facebook. Most people think of Facebook as a social network. Photos, memes, your uncle's political opinions. But quietly, Facebook has secured around 50 regulatory licenses across the United States specifically to allow money transfers through Facebook Messenger. 50 licenses. That's not a side project. That is a strategy. Then there's Amazon. Amazon, the company that already knows what you buy, what you want to buy, and sometimes what you need before you do, has experimented with student loans, essentially dipping its toes directly into one of the most personal areas of personal finance. And Apple Pay has made tapping your phone at a checkout counter feel completely normal. What once seemed futuristic is now just Tuesday. But the real scale, the jaw-dropping numbers, are coming out of Asia. If you want to see what the future of finance could look like in the West, look east. Let's talk about Alibaba, China's answer to Amazon, and its financial arm, Ant Financial. Ant Financial launched a money market fund called Yuebao, which literally translates to leftover treasure. It was designed for ordinary people. You didn't need to be a sophisticated investor. You didn't need a brokerage account or a financial advisor. You could invest the spare change sitting in your digital wallet, less than $1,000, and start earning returns. The result? Yuebao became the third largest money market fund in the entire world. Not in China, in the world, driven almost entirely by everyday people investing tiny amounts through an app they were already using to shop online. That is extraordinary. But even that pales in comparison to what Tencent has built with WeChat. WeChat started as a messaging app, like WhatsApp, but today it is a full-blown financial ecosystem. WeChat Pay processes billions of transactions. Users buy insurance, they book taxis, they send money to family, they split dinner bills, they invest, they can even find a date, all without ever leaving the app. One app, one digital world, no bank branch required. And the question that should be keeping every bank CEO up at night is, how do we compete with that? Now, I want to pause here and address the obvious pushback. But wait, you might say, I don't want Facebook handling my money. I don't trust them with that. And that's a fair instinct. But here's the thing. Let me ask you something. Do you trust Facebook with your family photos, your conversations, your birthday, your location, your relationships? Do you trust Amazon with your home address, your credit card, your shopping habits, your voice through Alexa? For hundreds of millions of people, the answer is already. Yes, we've already handed that data over. We already live inside these ecosystems. So here's the uncomfortable question. At that point, is handing them your bank account really that much of a leap? Think about the next generation, Gen Z, the kids who grew up with iPhones before they had debit cards. When they turn 18 and need to open their first bank account, are they going to walk into an HSBC branch, or are they going to tap Open Account on their Apple Wallet? Traditional banks have spent decades building brand trust. Big tech has spent a decade building something more powerful, daily habit. Okay, so here's the real genius and the real danger in all of this. Because when people hear big tech is becoming a bank, they imagine Apple and Google applying for banking licenses, taking deposits, managing risk, dealing with the Federal Reserve. And that sounds complicated, slow, expensive, heavily regulated. And you know what? Big tech knows that too. Here's the truth. They don't actually want to be banks. Not entirely, not the boring parts anyway. What they want is something far more strategic. They want to control the front end, the profitable consumer-facing layer of banking, the payments, the user experience, the digital wallet, the interface where you and I interact with our money every single day, the branded, beautiful, seamless touchpoint. And if they can own that front end, they can leave the back end, the regulatory reporting, the compliance burden, the post-trade settlement, the vault keeping, to the traditional banks. Think about what that means. Banks become utilities, invisible infrastructure, the plumbing that nobody thinks about. They're still necessary, yes, but they're no longer the ones with the customer relationship. They're no longer the brand on the tip of your tongue. They become the back-end server for Apple's financial product. That's not just a business disruption. That is an existential threat to the entire banking industry as we know it. Because when a bank loses the customer relationship, it loses the data, the loyalty, the ability to cross-sell, and ultimately, its relevance. Banks could find themselves stuck as commoditized, behind-the-scenes providers, doing the heavy regulatory lifting, while big tech skims the cream off the top, all the profitable, engaging, high-margin interactions. So, where does that leave us? We're standing at one of the most fascinating crossroads in the history of money. On one side, you have institutions that have managed wealth, survived wars, and navigated centuries of economic cycles. On the other, you have some of the most powerful, data-rich, and habitually embedded companies ever created. Banks have regulation, trust, and history. Big tech has speed, data, and daily presence. Neither side is going away, but the rules of engagement, the very shape of finance, are being rewritten in real time. And honestly, the outcome might not be one winner. It might be a new kind of hybrid, where your bank of the future is part Apple, part JP Morgan, part algorithm, and part regulation, where you never think about the infrastructure because you're too busy tapping your phone. But one thing is certain, the battle has already started. So here's what I want to know from you. Drop it in the comments right now. Who do you think wins this battle? The tech giants with their billions of users, seamless apps, and relentless innovation? Or the traditional banks with their regulatory power, financial expertise, and deeply embedded infrastructure? Is this a knockout, a merger, or something we haven't even imagined yet? Tell me below. I read every comment. And if this video made you think differently about who actually controls the future of your money, smash that like button because it genuinely helps this channel reach more people who care about this stuff.